Host. Hey everyone, welcome back to the channel. In today's video, we're going to dive into a concept that's super important but often misunderstood: credit creation and contraction. It's something that impacts the economy, your financial decisions, and even host voiceover. The interest rates you pay on loans. Let's break it down step by step. First, let's understand credit creation. Imagine a bank is like a giant money factory, but instead of printing physical cash, it creates credit. So how does this work? Host voiceover. When you go to a bank and take out a loan, say for a car or a home, the bank doesn't actually hand you a pile of cash they have in their vault. Instead, they create a deposit in your account, money that wasn't there before. This is credit creation. Host. Basically, the bank is able to lend out more money than it actually holds. This is because banks are required to keep only a small percentage of their deposits as reserves. The rest, they can lend out and charge interest on it. Host voiceover. This process is called the money multiplier effect. For example, if the reserve requirement is 10%, the bank can lend out 90% of the money deposited into it, which gets redeposited into other banks, creating even more credit. Host. Think of it like a snowball rolling down a hill. The initial deposit grows bigger and bigger as it circulates through the banking system, creating more loans and therefore more money in the economy. This is how credit creation fuels economic activity. Host voiceover. But wait, it's not all sunshine and rainbows. Credit creation can also go the other way: credit contraction. Host voiceover. When the economy gets too hot, or when banks need to build up reserves, they might tighten the amount of credit they create. So instead of lending out more money, they start pulling back on loans. Host. Imagine you're a small business owner trying to take out a loan to expand, but the bank tells you, sorry, we've tightened up lending. This is an example of credit contraction. Host voiceover. Credit contraction slows down the economy. Less borrowing means less spending, which means less investment, fewer jobs, and potentially even a recession. It's like a snowball that's losing speed and shrinking. Host. That's why central banks, like the Federal Reserve in the US, play a crucial role. They adjust interest rates to manage credit creation and contraction. Lower interest rates encourage borrowing, creating more credit, while higher interest rates make borrowing more expensive, contracting credit. Host voiceover. So, whenever you hear about the central bank changing interest rates, know that they're trying to control how much credit is being created or contracted to keep the economy stable. Host. Now, how does all of this affect you? Well, when credit is flowing, it can be easier to get a loan for things like a home or a business. But when credit is contracting, it might become harder to borrow money, and you might see interest rates rise. Host. So next time you're considering a loan, or when you hear about the economy slowing down, remember, it's not just about numbers. It's about credit. How much money is being created and how much is being pulled back. Host. Credit creation and contraction are like the heartbeat of an economy. Understanding these forces can help you make smarter financial decisions, whether you're borrowing money, investing, or saving. Host. If you learned something new today, give this video a thumbs up. Got questions about credit or the economy? Drop them in the comments below. And don't forget to subscribe for more videos that break down complex topics into easy to understand explanations.